As of 11:50 Eastern Time, SoFi Technologies, trading under the ticker SoFi, is priced to $25.75, experiencing a downturn of 2.54% for the day. Volume is heavy, already hitting over 83 million shares, far outpacing its average. The stock is fluctuating between a day's low of $25.64 and a high of $27.33. Now, on the surface, this looks like a typical volatile session for a high-growth fintech name, likely reacting to broader market jitters. But that immediate conclusion, that simple read of the tape, is exactly where most investors are making a critical mistake. They see the red on the screen and assume the growth story is cracking. The reality, however, is that this intraday turbulence has very little to do with SoFi's fundamental trajectory and everything to do with a macroeconomic tug-of-war that is creating a profound misunderstanding of the company's actual strength. The market is pricing in fear, while the company's internal metrics are screaming acceleration. This disconnect is the single most important factor for anyone looking at SoFi stock right now. The prevailing expectation surrounding SoFi has always been a straightforward one. It's a high-beta fintech company, a proxy for consumer financial health, and heavily leveraged to the student loan refinancing market. For years, the narrative was simple. When student loan payments were paused, the stock suffered. When they resumed, it would rally. When interest rates rise, its lending margins get squeezed. When they fall, it's a clear runway for growth. This is the story you'll hear on financial news channels, the one that governs the algorithmic-driven trades causing today's dip. But that narrative is now dangerously obsolete. It fails to account for the most significant transformation in the company's history, its evolution into a full-fledged, nationally chartered bank. This isn't just a minor detail, it fundamentally rewires the entire investment thesis. The market is still treating SoFi like a speculative, non-bank lender, while in reality it's operating with the powerful economic engine of a deposit-holding institution. The expectation is that SoFi is at the mercy of capital markets for funding. The reality is it now controls its own destiny with a rapidly growing, low-cost deposit base that competitors like Robinhood or even some neobanks can only dream of. Let's dissect the recent stock movement with this new framework in mind. Today's drop is part of a broader market pullback, but the volume tells a more nuanced story. The high trading volume isn't just panic selling, it's a battleground. On one side, you have programmatic funds selling off tech and finance names in response to slight shifts in treasury yields. On the other, you have institutional investors who understand the banking charter's implications, likely using this weakness as an opportunity to accumulate shares. Recent filings show that institutional ownership now sits at over 50%, with major players like Vanguard and BlackRock holding significant stakes. These large firms don't make billion-dollar bets on a simple student loan narrative. They are investing in a diversified financial services platform with a critical strategic advantage. The market sees a fintech stock declining, but the smart capital sees a future banking giant on sale. This is where you see the disconnect play out in real-time trading. The so-called dumb money sells the headline, while institutional buyers are quietly building their positions for the long term, something many individual investors using platforms for self-investing, whether it's Fidelity, Schwab Intelligent Portfolios, or SoFi Invest's its own SoFi Invest, need to be acutely aware of. The latest quarterly results completely substantiate this reality. SoFi reported a seventh consecutive quarter of GAAP profitability, with net revenue soaring 43% year-over-year to a record $855 million. Adjusted EBITDA was up an astonishing 81%. These aren't the numbers of a struggling lender. They are the figures of a company hitting a powerful acceleration phase. The most critical data point, however, was the growth in members and products. SoFi added a record 850,000 new members, bringing its total to 11.7 million. This isn't just about lending anymore. The financial services and technology platform segments, which include SoFi Invest, SoFi Money, and its technology arm Galileo, generated over half of the total revenue and grew at a staggering 74% year-over-year. This is the engine the market is largely ignoring. The expectation is that SoFi's fortune is tied to loan origination volume. The reality is that its financial services productivity loop is working flawlessly. They acquire a customer for one product, like an online investment account or a high-yield savings account, and then successfully cross-sell them into other products, dramatically lowering customer acquisition costs and increasing lifetime value. This ecosystem approach is something that more specialized platforms, whether it's Robinhood for stock trading or others for crypto, have struggled to replicate effectively. For those who may be newer to the story, SoFi, which stands for social finance, began its life focused on a niche market. refinancing student loans for high-income graduates. The business model was simple and effective. They targeted a low-risk, high-income demographic and built a brand around community and financial wellness. For years, this was its primary identity. But under the leadership of CEO Anthony Noto, the vision expanded dramatically. The goal was to build a one-stop shop for all of their members' financial needs. This led to the introduction of SoFi Invest, personal loans, mortgages, credit cards, and cash management accounts. The pivotal moment, however, came in 2022 when it received a national bank charter after acquiring Golden Pacific Bancorp. This allowed SoFi to take its own deposits and use them to fund its loans, a far more stable and profitable model than relying on warehouse lines of credit or selling loans in the secondary market. It's a fundamental shift that many retail investors still don't fully appreciate, often lumping it with other fintech apps rather than seeing it as a challenger to traditional banks. While many users may come for the slick interface of the SoFi trading platform, they stay for the integrated banking features that create a sticky, all-in-one financial relationship. Looking forward, the landscape is ripe with catalysts that could force the market to abandon its outdated narrative. The primary one remains the macroeconomic environment. While rising interest rates in the past created headwinds, the current outlook for potential rate cuts creates a dual benefit for SoFi. First, lower rates will naturally boost demand for its core lending products, especially personal loans and student loan refinancing. Borrowers who are hesitant to refinance in a high-rate environment will be incentivized to lock in lower payments. Second, and more importantly, as a bank, SoFi's net interest margin, NIM, is positioned to perform strongly. Its ability to attract low-cost deposits through its high-yield checking and savings accounts and lend that capital out at higher rates is the fundamental business of banking, and SoFi is executing it with the efficiency of a tech company. The market expectation is that SoFi is just another company hoping for rate cuts. The reality is that its banking charter allows it to profit from the interest rate spread in a way that its non-bank fintech peers cannot. This is a durable, long-term advantage. Comment below with your thoughts on the Federal Reserve's next move and how you think it will impact the fintech sector. Of course, there are risks to consider. The competitive landscape is fierce. SoFi is not only competing with tech-focused peers like Robinhood and SoFi, but also with the digital offerings of incumbent giants like JP Chase and Bank of America. Furthermore, its technology platform, Galileo, which provides financial infrastructure to other companies, faces competition from the likes of Marqeta and Adyen. Another significant risk is credit performance. While SoFi's underwriting has historically been strong, focusing on a high-quality consumer base, a severe economic downturn could lead to an increase in loan delinquencies and defaults. The company's ability to manage credit risk through a recessionary period remains a key test that investors will be watching closely. The valuation also reflects high growth expectations, with a price-to-earnings ratio that is well above that of traditional banks. If member or revenue growth were to slow down significantly, the stock could face substantial pressure. Investors must balance the immense potential of its integrated business model against the very real execution risks and competitive threats in the financial technology space. Platforms like Interactive Brokers offer sophisticated tools for advanced traders, highlighting the need for SoFi to keep innovating its SoFi Active Investing platform to retain and attract serious investors. Similarly, the breadth of products available through Fidelity Investments, from Fidelity ETFs to Fidelity mutual funds, sets a high bar for any platform aiming to be a comprehensive investment solution. In conclusion, the current intraday price action of SoFi stock is a perfect illustration of the conflict between an outdated market narrative and a rapidly advancing business reality. The expectation is that SoFi is a volatile fintech stock, susceptible to every ripple in the bond market and still heavily reliant on a single product line. The reality is that SoFi has successfully transformed into a diversified, tech-driven bank with a powerful ecosystem, a loyal and growing member base, and a funding advantage that sets it apart from nearly all of its digital native competitors. The market is selling the story of yesterday, while the company is building the financial institution of tomorrow. The recent profitability, record member growth, and the strategic leverage of its bank charter are not temporary bright spots. They are evidence of a superior model hitting its stride. For investors who can look past the short-term noise and focus on the fundamental strength of the business, the current disconnect between perception and reality may represent a compelling opportunity. The story is no longer just about student loans. It's about building a durable, profitable, and comprehensive financial services powerhouse.